Hello and welcome to the Restart Michigan webinar, Financial and Operational Strategies to Weather Uncertain Times. I'm Lori Ostro, the Senior Director of Engagement with the Detroit Regional Chamber. Thank you for joining our session today. The Chamber launched this series of webinars to help businesses across the state prepare to restart and open their operations and return to work. I would like to thank our guest speakers from UHY for volunteering their time to share their expertise. Before we get started, I wanted to make you all aware that all participants are on mute, but you do have the option to submit questions directly to the speakers through the GoToWebinar control panel. I will now turn the webinar over to Tom from UHY. Thank you.
Good morning and welcome. Thank you for joining us this morning. Our topic, is very timely given, if you looked at the stock market today, it's down almost 1,000 points, right? It's been like a roller coaster. But, here we are, we're really focused on this road to recovery. And, now's our time to really, from a financial and operational perspective, take the time to really put together a solid plan to help you weather the storm. This morning I have with me is Alex Conti. He's a leader in our corporate finance team. And we'll be discussing really, access to capital and some of the tips and tools and strategies that the pros use to dealing with lenders and working with lenders. Cindy Hannafy, who's usually on a flight somewhere, we were able to, is now not quarantined, but now in her home office. We're really pleased to have her with us. She leads our transformation practice and is extremely busy, as you can imagine, with so much going on. So today, the agenda that we have for you is really around, we're going to start out around liquidity planning and really looking at some other sources of debt and equity. As we think we're coming out of the storm, I have a lot of clients that some are doing fantastic. Some are like, it's still a slow go because of supply chain. Depends, it's really industry specific. So there's a lot going on, and now's our time to really make sure that we have a good plan in place, because we keep hearing these, and we just read it this morning about the second wave, right? And what will that do to the economy? So we need to make sure that your business has a plan to get to the other side. And we'll talk a little bit about, what has this pandemic, really taught us, about our business models, and how can we really utilize that to really grow financially and operationally through some different strategies. So we're pretty excited to get going on our topics here. So this is it's an eye chart. You can make it larger on your screen, but this is something that we rolled out right when the pandemic started, kicked off. And it really was, a lot of 911 calls from our clients, and, us being proactive and getting in front of them. And, that stopped the bleeding. We're past that, really that stage. Hopefully, many of you may have tuned into, our PPP loan program, a lot of grants, a lot of different avenues to shore up, your short-term liquidity, which is obviously very critical, right? So we had to stop the bleeding, right? And, for many companies, that PPP loan, I was very surprised that really was a nice, in some cases, a Band-Aid. In other cases, it was a shot in the arm to really help companies, move forward. But today, we're really looking at, we're into this, for some, we're already in this recovery side of it. We're already in the green. Others, we're still kind of weathering the storm. And we're going to talk about a few, mostly we won't be able to talk about all these items, obviously. But cash control and really financial management is a place that we're going to look at in our presentation. And Cindy's really going to focus on operational excellence. This is really a time, I know we want to pull back and stop innovating, but now more than ever do we feel like now we're in the future. The future is now, and technology is taken off like never before. I see it in, I'm just at a restaurant, and the way the menus, I use my phone. There's all kinds of things going on out there. So technology is going to be a big leader. So liquidity planning is critical. We hear this, and obviously it's, it sounds simple, right? Yeah, cash flow, right? But very few companies that are a little tight on liquidity really manage through effectively through a 13-week or 26-week cash flow. It's too time consuming, it's too hard, but this is really a time when I look at the banks that are lenders are saying, okay, the PPP kind of got you through that, maybe helped you, but what does this future really look like? What does the next 13 or 26 weeks look like? And if you're a lender who hasn't asked you for, one, they're, and they may be, depending on, your availability of liquidity. And so we'll talk about that a little bit. But this is, to me, the foundation, the benchmark, whether we're weathering the storm or even this is good hygiene, even as you go forward, right? And, now more than ever is to really incorporate some sensitivity analysis, right? Really take that and build a baseline case, an upside case, and a downside case to really understand your risks. If we understand that, then we can build a plan around it. There's so many clients and business owners that we meet get frozen. It is very, very difficult when you're living and breathing your business and it just stops. We get it. And, it's all about, building a plan to make sure you can get to the other side. But it starts here. It starts with understanding your net working capital, right? When we say that, your current assets minus your current liabilities. And even more simply, really looking at your receivables, your inventory, and your payables. Those are real 3 driving factors on your balance sheet from a net working capital perspective, and it almost, you take this gap measurement, accrual a little bit out of it, and you really get down to kind of a more cash basis, cash in, cash out. And it's also very critical to separate your operating versus non-operating items. So let's just take a look at an example. So, this thing is very touchy. A 13-week, geez, a bit of a delay. A 13-week cash flow. This is a snapshot. This is just a mock-up, sample scenario. But this is the baseline of really where it starts. And we start out with beginning cash. In this example, we're starting out with no cash. We're adding in our collections, and it's really about the big part there is really looking at your beginning AR, right? Your big hitters. One of those are going to collect, and you kind of drop those in by week. Sometimes that's again, that's a little bit of somewhat of a guess. Some of it maybe pay very much on time, so that can be easier or harder for some. And then really baking in, your new credit sales and any potentially in your business if you have cash sales. But credit sales is the most obvious one that most companies have. So to really build up, your weekly cash receipts. So from there, we're really focused on disbursements, right? And then the hard part is again managing your payables, right? Who do I pay? And so many times that we see is, companies someone calls and like, we need payment, and we're quick to let the air out of the balloon and make those payments. this model, this tool will help manage that so that you don't get into a place where looks like you have cash because collections have come in, right? But now sales, for the last, April, May, in many cases are not much. So your borrowing base, what you're working off of, is very, very low. So that's why this cash flow is very, very critical. And then you're listing out all your regular disbursements of payroll and payroll taxes. And even importantly enough is to layer in, your usage of, in your beginning, if you had a PPP loan. We use that in our clients' cash flows to, layer that in, because obviously that's cash available to you. So layering in, and you can see, where we have, some red, hiccups there where we're kind of negative. We're using more cash than we're bringing in. And so that's very, very critical to understand as we go into the planning. And the summary of it, and this is a very high level, this is a Cliff Note version I'm giving you of a 13-week that has a lot of tabs and a lot of information in it. But this is really the dashboard that, your lenders are going to look at. They're really going to watch, your line of credit. And, obviously in many cases that could be, it could be very low right now because you've collected out receivables, and I want to say you almost self-liquidated in a way, and now you got to rebuild that working capital, right? And so when you rebuild that working capital, you're paying payroll, you're paying things that you're faster than you can even invoice or collect. So it's almost like a startup company where you have more cash out than you have cash coming in. And so, and in some cases we've seen, where companies are going out of formula where they're on their line of credit, depending if they're a monthly remitter, so to the bank. So you have to look at this. They're really focused on this availability. And in this case, you can see, hey, we had availability and now we're burning it up. We burned right through and hypothetically, this is what our projection would look like if we don't do anything. So very, very important, very, very critical chart that is really watched. And another thing is down is that net working capital on your receivables and inventory. You can see here that our receivables were started at $1.9 million and now we're at $869. So sales have really dropped. So our working capital is shrinking, and we're in an upside down position potentially in our out of formula. So, what is some of the plan, to deal with that, right? Well, one is, we see often is companies will complete a 13-week and it shows, this very dire situation where, their working capital, goes upside down, and, but they need to pay vendors. And so what do you do, right? Well, the first thing is that you don't want to just throw that over the wall to your lender and say, hey, here's what it looks like. You want to have a plan. You want to have a way to really look at, how do you work with, what are your options? Because the lenders, at a very high level indicators, they're kind of looking at these things. Are you profitable? How much do you have on your availability? Is your funded debt to EBITDA? When that starts getting above 3 times, depends on industry, but those are all indicators that say, where are you at in this process? So we really want to make sure we're monitoring actual results versus a plan, so that you can put together in place a plan that shows maybe the bank will give you an over formula advance, right? If they can show that there's a turn coming up in the availability. And really, finally is really looking at and leveraging what we talked about as far as vendor payments and working capital, right? Don't just let the air out of the balloon. Make sure you're working out agreements to, ensure your liquidity, because ultimately you have to get to the other side. And some companies have done very well at this. Some are still struggling through this, and we're working with, some of our clients on this very matter. But, be resourceful here and making sure that, and are you going back to your, key suppliers? Is there opportunity? Obviously, resin prices, oil prices are very low. Make sure you're taking advantage of everything we can here. So I know we have a short window of time, and so I want to bring in Alex to kind of work through some of the lender engagement plan.
Yeah, thanks, Tom. Just following on to those comments, I think it is important to have really good communication with your lenders and your financing partners. And, it's always better to ask for permission than forgiveness when you're dealing with a creditor. And leveraging what Tom went through and using that 13-week cash flow or a projection model to dictate what you expect to have happen is important. And when you see a bogey out on the horizon, there's a cash constraint coming up. What levers do you have to pull to give you some availability? And the key there is you have to know it before you can act on it and communicate with the lender. So that's why that tool can be so important. And getting those partners to buy into your business model or what you see. And again, it's not a perfect crystal ball, but it can be very directionally correct. And at least that partner, that financing partner, is going to understand that whatever springs up was truly unexpected, and that you had a plan. And so again, you're going to get more of a cushion with them if you're proactive in that approach than you would if you're pushing the 911 button. So I think it's really critical to use that tool to your advantage and think about the future and the critical, cash receipts and disbursements that you're going to have as a business operator.
Sorry,
in terms
just
of
interject. Sorry, just exact point there, Alex, is that we can't act on some of the things that we're going to talk about now in the bottom of the ninth. We have to be able to, as almost a crystal ball, see these things are going to happen to give us some time to put an action plan together.
Yeah, that's a great point. And here on the slide, we just have a few other options that you may be able to take advantage of depending on what type of facility you have in place. But some of you may be familiar with factoring accounts receivable, which is basically selling the receivable at a discount to face value, where you can get cash more immediately. You could sell for 80 cents on a dollar. When that factoring source collects, they would pay an extra 15 cents, and then they would keep the remaining 5 cents as the fee for factoring. But that provides you with a more immediate source of cash inflow, as opposed to kind of borrowing on a constrained line of credit. The other piece is equipment financing. If you've got unencumbered equipment or assets that you can borrow on and use as collateral for cash, that's an option. Just focusing on the balance sheet and what you have to use to get through a difficult period in the operating cycle. Sale leaseback, again, that's more typical with either real estate or machinery and equipment. So you're selling that asset, and then you're paying basically a rental stream for the use of that going forward. But again, it provides a pretty significant lump sum on a more immediate basis. And then obviously with what the government's been doing over the past several months, the PPP CARES Act, and then the Main Street Lending Program, which I know, Tom, you'll probably talk about in a couple of slides here. So, and again, the last 2 points, just looking at your borrowing base, I don't know if it's a bi-monthly or a monthly activity, maybe accelerate that to weekly, and you look for the potential shortfalls, and you get ahead of the conversation with your lender. When you're providing an ask, or when you're asking the bank for something, it's always better to have detailed support. That you're dealing with numbers people, so showing them that you're using somewhat of a sophisticated tool, to identify the issue and looking out beyond that for mitigating factors and a solution down the road is going to provide you with more flexibility with that counterparty. So next slide here, if we could.
A little
flip
slow.
to- Tom's still using a dial-up connection apparently. So I think we're looking for the access to, yeah, if you click in there and use the arrow button. Okay, so here's a few points on just access to capital and alternative sources. Obviously the bank and your senior secured lender is the most traditional form, but there's a lot of others out there, and it's not, no business model is a one size fits all. So it's important to think about if you're not getting what you need from, the current partner, or they're not willing to take that added risk or the next step in providing liquidity or financing for an issue that you're going through in the operating cycle, you have different options. And so we've got a couple just listed here to go through. There's a lot of folks out there that are now non-bank lenders. What does that mean? Well, most typically it's a private equity fund or firm that has created a specific credit fund as an investment vehicle. They're not regulated entities, so therefore they're willing to take on riskier deals. They don't go through the same stringent process that a senior lender may go through. The compromise there is that the capital could be pricier as compared to a bank who's more secured. The next source here is mezzanine or junior capital. I don't know if any of you are familiar with that. But that's basically debt that is subordinated to your senior secured traditional bank capital. So it's they're sitting behind the bank in a junior position. And the way that capital tranche functions is it's not going to amortize. It's going to pay a higher coupon rate. So again, more expensive than your traditional senior secured financing. And then there's a lump sum because the debt doesn't amortize. You have a lump sum due at the end of the term. And if you're wondering why you might use mezzanine or junior capital, the most effective or the most realistic use of that is that you have a program or something that you're preparing for in the near term that's going to pay or become lucrative toward the back end. So if you think of manufacturing business. If you're trying to be awarded a program and you have to buy a lot of equipment initially to support that program, that might be a need for junior or mezzanine capital. Or if you're planning for a liquidity event such as exiting your business, if you're looking to sell down the road, you could take out some junior capital initially, and then when you're ready to make a full transition and exit the business, you can use the proceeds from the exit to pay back the junior capital. So it's kind of a risk mitigating factor where you take some chips off the table initially, and then you plan for a bigger liquidity event down the road. So structured equity or preferred equity, very similar to the mezzanine structure. The key difference there is it's not going to pay cash interest. So you don't pay, you don't have principal repayment, and you don't have cash interest. You basically accrue the interest, and that's added to that lump sum that you would pay at the end of the term of the structured equity investment. And one other distinguishing factor there would be a convertible feature. A lot of times a structured equity or preferred equity investment would allow the investor to convert to common shares, at a predefined rate. And so then therefore they could become a partner in the common equity. But again, we're just kind of moving down the balance sheet from your senior lender, your junior lender, your preferred equity, and then obviously you get your common equity. And within that common equity part of the capital stack, you have potentially a minority investment. So if you are, again, thinking about a larger exit down the road, and if you're looking for near-term liquidity on the equity side or a partner that might bring some unique value to the business, you can sell less than 50% of your common units. And, again, that individual, depending on the operating agreement, wouldn't have any control. They would be kind of silent capital, and it's a step toward a larger exit down the road. So, with that, again, there's just a multitude of different options outside of your traditional senior secured bank lender that you may have if you need it. So with that, Tom, I'll let you kind of get into
Yeah.
the Main Street lending program here at the bottom of this slide.
And I think obviously we're not, the banks have been a little bit, not aggressive just yet. Obviously, most, companies had a decent still first quarter. So if you had, first quarter covenants, you're in compliance. But now when you start getting to second quarter and third quarter, what will happen if you kind of bust through those covenants, and what's the plan there, right? If you're rebound, if you don't have a nice robust recovery, right? But the Main Street lending program, really could be another shot in the arm. And some clients say, well, I don't really need it. I'm in good shape, right? But the problem is this is different than we've ever seen before. We just don't know. I mean, is there a second wave? Is it true? Is it, going to get worse? Or are we going to get shut down again? And so why not make sure we have enough liquidity on our balance sheet, right? And, even if, the nice part of this program, there is a cost, it could be a couple percent, the loan size, but it's really nice in the fact that there's no prepayment penalty. So if we do get a year from now and, we just, pay the interest at, LIBOR plus 300, which is a lot cheaper than mezzanine or some of these other sources of debt and capital structure here. So, and they just came out on, I think it was on Friday, some changes with their, the minimum loan size is now 250,000 for the priority in the new loan facility. And they're 5-year terms now. So, when you look at these, and we're looking at several, these programs for several of our clients, and we have some calculators to kind of go through this. It kind of makes sense, because when you look at traditional lending and where they will go, in a very, depending on industry, senior lenders are, 2 to 3 times on EBITDA, to funded debt. These are going to, 4 to 6 times. So you're getting another potential turn or two to kind of shore up, the balance sheet. Is it leverage? Yes. But if you don't need it, hey, these are the things to start thinking about now, because you want to get these. This program is not quite ready for prime time. It's supposed to be ready, I mean, any day now. So there's a nice opportunity here to look at that.
Yep. So this slide now, just trying to get folks to consider the bigger picture and think strategy and what's the end game for an owner and operator, as you come into the a trough in the cycle here. When you come out of this thing, do you have 2 years, 5 years on the horizon that you want us to stay in the business, or is it much longer? Do you have 15 or 20 years? And depending on that kind of global strategy, as a shareholder and your objectives, should dictate what you do opportunistically at, a soft spot in the cycle here. And so just thinking about, is your business going to be consolidating and acquiring or growing through acquisition? Or are you on the path toward, a more near-term transition and exiting the business? So knowing that and thinking about that will allow you to capitalize on opportunities, at this juncture where, there is a lot of uncertainty in the market. And so, if you find that you are going to be a consolidator, this is a great time to think about who could be a good tuck-in acquisition, or who could be an accretive partner for you in your business as an operator. So identifying potential partners or targets, or thinking about new geographies to go into, tangential industries, what product lines or services can you offer that will be an enhancement to your core business. And then thinking about, conversely, if you're thinking about an exit, what steps might you want to take at this point to sort of de-risk because there's a lot of folks out there where you may not emerge from this period as strong as you went in, and that's fine. It could be that you're fatigued and you may not be in it for the long haul. So thinking about that and what the right plan is relative to a transaction and the global strategy for the business is important. We've got a couple different potential acquirers listed. We talk about strategic acquirers and financial buyers. Again, just the basic difference there. A strategic acquirer, a strategic partner is a business that's in a similar industry. So Coca-Cola acquiring a smaller beverage brand would be an example of a strategic deal. On the financial side, it's again a private equity firm is your typical financial buyer. It's a group or an investor that is acquiring a business solely as an investment, under a defined investment horizon. So you can think about the right partner there for your business. On the strategic side, again, they're ready to go as investors. They may not need the existing management team, whereas many of the financial buyers are not operators. They're looking at making an investment. Oftentimes they want to partner with the existing shareholder group or the existing management team and continue to grow, add value, add capital to the business, but they're not going to be in the driver's seat. So knowing which of those that you fit with is important. There's also a group out there called special situations investors or restructuring investors. Again, those are situations where the business might be more challenged than it otherwise has been in the past. Could be underperforming, but there's a group of investors out there that look for those opportunities. So if you find that that's the case, there's no reason to be discouraged. Again, similar to the senior secured lender versus all the other lending options, there's a whole host of different types of sources of capital and options for an owner who's thinking about whether they want to be buying or selling kind of long term. And the last piece here is just an intergenerational transfer or succession planning. So if it's a family-owned business, thinking about the next generation, a lot of times folks focus on what they need to do to groom that next generation to be a capable operator, but it's also important to think about what does the business need to be ready for, perhaps a younger or less seasoned operator. If you're turning over the car, are you giving somebody a vehicle that just had a tune-up and a fresh oil change and is ready to go for 3,000 or 10,000 miles? Or is a situation where that next person getting into the driver's seat is going to have a lot to do to work on a vehicle to get it going right? So good things to think about globally at this stage in the market. And the last 2 points I'll make on this slide very quickly here, just the speed and timing of a deal process. Under an expedited scenario, I think the soonest that folks can get deals done, whether you're buying or selling, is 2 to 3 months. So it does take time, and under a normal operating or normal kind of deal process, it can be 6 to 9 months. So think about what's going on with the business, whether it's your business transacting, or it's a target or partner that you're going to be folding into an existing operation, and what can happen in that time frame. And relative to value, again, I mean, it depends whether you're buying or selling, but the simple concept is buy low and sell high. It's important to think about your business or the target business and how that is performing specifically, and also how is it performing relative to the M&A market. So if you're a buyer and you're consolidating, you want to think about finding a business or opportunity that might be underperforming, where you've got a little bit of a discount on value. And if you can do that in a softer M&A market where multiples across the board are lower, that's a great situation. You got two things going for you, and it's a buy low situation. If you're on the other side of it, you want to have kind of strong business specific performance, and you want to have a strong M&A market if you're thinking about an exit. So I'll stop there. I think we have Cindy.
Turn it over to Cindy. Cindy's going to kind of walk us through the operational excellence.
Great. Thank you, Tom and Alex. Appreciate that. So UHY's crisis management team has published quite a bit of articles around Stop the Bleeding, Weathering the Storm, and now we're publishing a few articles on the road to recovery, and we've posted those to our website. So we've experienced and we've experimented and we've learned quite a bit from the pandemic. Our economy, our culture, our lives are continuing to evolve in the process. So what have we learned? Previous to the pandemic, we experienced about 60 months of economic prosperity. And what we find happens in that time is that we're really chasing that top line revenue, we're servicing our customers, and we're prioritizing that first, but we're forgetting about, or it removes focus, or it camouflages our focus on our inefficient processes, organizational structure, and technologies, and maybe even some unprofitable products and service lines. So what happens is that when the economic chimes are shifting and the revenues start declining, that onion peels back and those inefficiencies in your organization surface to the top. And unfortunately, that happened very rapidly with the onset of the pandemic. During this time, we've seen some pandemic winners and some pandemic tragedies. Some of the tragedies, as you know, retail, the traditional brick and mortar, JCPenney's, Neiman Marcus, J. Crew, all filed bankruptcy, and there's so many more on the watch list. Travel and entertainment, oh my gosh, has that been hit? Airlines, hospitality, cruise, Hertz filed bankruptcy. It's going to take longer for that industry to recover, and it might be changed forever because we've gotten pretty used to virtual meetings versus the in-person meetings. Not to mention oil and gas, less business and personal travel, less commuting, fewer cars and buses on the roads. Large companies like Diamond Offshore Drilling, who in 2019 had $981 million in revenue, just filed for bankruptcy. According to FEMA, 40% of the businesses do not open following a disaster. And I think we can agree that this pandemic has been quite the disaster. And on top of that, 25% fail within 1 year of reopening. So it's not very encouraging. And Washington Post has reported that more than 100,000 small businesses, the cornerstone of our nation, the #1 largest collective employer, have closed for good. And that toll continues to escalate. We've seen an increase in Chapter 11 business reorganization filings year over year. March, a 17% increase, and April was a 26% increase. But during this, we've also had some pandemic winners. So I define the pandemic winners as those companies who have survived and still have sustainable business, even with some setbacks. The obvious winner in the category is Amazon. They take a great trophy as the nation totally shifted from retail to online ordering and delivery. And they had some hiccups. They had COVID safety protocols issues. They had logistics and delivery issues. Those of us who enjoyed same day or second day delivery didn't get that. Supply chain was impacted, but they quickly pivoted and engaged third-party service providers and alternative suppliers to compensate for increased demand. And you know what their reward's going to be? They're going to emerge from the pandemic with a longer term shift in how consumers shop. Now think about all the suppliers to Amazon, packaging supplies, third-party delivery providers. They've seen a favorable impact to their business as well. Technology also. Zoom, GoToMeeting, WebEx, Microsoft, all of the technology companies have really taken off. So these companies were able to quickly pivot and innovate and respond to a need. And our ability to quickly pivot and respond to rapid changing strongly influences and supports our long-term sustainability. So what these companies are doing, these pandemic winners are doing differently, is the concept called operational excellence. It's a focus on the whole organization, not just on top line revenue. It's processes, technology, it's organizational structure, it's revenue, it's customers, it's everything. Next slide, please. So I want to read you a Millikan quote that a friend of mine shared with me. Operational excellence secures the presence. the present, and innovation excellence secures the future. And what this means is that if we focus on operational excellence, being lean and agile in ordinary operations, then we can pivot and quickly seize innovative opportunities, whatever the economic condition. Amazon understands this. It's an innovation company. They pride themselves in understanding what their customers need before they actually need it. Their operations are lean, they're focused, and they figure out ways to improve the value flow constantly. It's a part of their culture. So what is operational excellence? So you can put the next slide up, please. It's really a culture with some blended in management systems and tools and principles. So you'll see in the definition, a couple of components of this are an integrated management system and a culture of operational excellence. So a culture here is where every member of the organization can actually see the value, the flow of value to the customer. Not only that, but they also are able to improve both the value and the delivery of that value. So operational excellence is about reducing costs. It is about increasing productivity in the workplace, but it's more about creating a culture that will allow you to produce valuable products and services for your customers and achieve long-term sustainable growth. So you do this by putting in the right management structure, the tools, the processes, where your employees are provided for in a way that enables them to be empowered and motivated. And when they are empowered and motivated, they innovate, they solve costly problems, and they address a need, and they create an opportunity for you. So next slide. So here's how operational excellence works. So you'll see up there, a company has vision, a strategy, also has goals and objectives. So a company sets its vision, and a vision is an aspirational statement where you want your company to go, what you want to be in the future. It's called what we call our why statement. Why do we do what we do? And everyone needs to understand your why from the top all the way down to the bottom of the organization. Otherwise, you're going to be working in all different kinds of directions and you'll never achieve your vision. The strategy is we call our what statement. These are our strategic pillars. What will we be doing to help us achieve our why? And then there's your goals and objectives. These are your how statements. Your goals and objectives are your stepping stones and how you're going to execute toward the vision and strategy. So most companies, most people in companies know what they do and how they do it, but they don't know why. They lack that inspiration, that meaning, that connection, that passion. So your vision, your strategy, and your goals and objectives, along with your people, are your foundation for your culture, and your processes and technologies are your organizational excellence tools. And used together effectively, you can deliver enhanced and efficient processes. You can enhance your automation. And you can achieve the value, the flow of value to your customers and meaningful growth. Remember, Millikan said operational excellence secures the present and innovation secures the future. So the intersection of these tools and the culture and the model produces those benefits. So next slide. So I've got a couple of little stepping stones here for your steps to summarize. So how you can put an operational excellence culture in place. These are steps for you to achieve that. Vision and strategy. One of the first things I ask employees of companies I work with is, what's your company vision? And many times I get a lot of blank looks. Dust off your vision, dust off your strategy. Are they still relevant? Does your vision articulate your why? If it doesn't, redo it. Do your employees understand your vision? If you don't, you haven't driven it down to your organization. If your employees don't understand your vision and they don't understand what it is, you're never going to get to where you need to be. Measure success, determine your KPIs. What gets measured gets done. Empower your employees. Give your people a good why, and they'll do any kind of what you want them to do. Give them the ability to measure their own performance so that they know what good looks like. This is where the actual innovation starts, People are going to fail. You've all heard about Edison, failed 10,000 times at the light bulb. Let them fail. Teach them to fail faster and recover quickly. Again, this is where the innovation starts. Publish your results. What gets measured gets done, but what gets published really gets done because everybody sees it. So publish the right metrics. It creates a healthy competition and it helps drive results. Communicate. This is really important. I'm trying to get through as quickly as possible. I know we're at deadline. These are meetings or brainstorming sessions where your teams gather to discuss results. But more importantly, it's a safe place where people are encouraged to bring ideas to the table to solve problems, improve processes, and find creative and innovative ways to use their technology and address your customer value. Make them regular. Never miss a meeting. Put your foot on the gas pedal and never take it off. Make this a habit. The more you brainstorm, the easier it will get and the better collaboration you'll have, and you'll be solving problems and creating value. And don't forget this, celebrate. It's so important. According to the U.S. Department of Labor, the #1 reason why people leave jobs is a lack of recognition. Let your people know that they're appreciated. Next slide. So I'll leave you with this one final quote. A company can seize extraordinary opportunities only if it's very good at ordinary operations. And what this is saying is focus on optimizing your ordinary operations. Get really good at it. It is at that point where you are agile enough to pivot and respond and quickly seize innovative opportunities. As Milliken said, secure the future. Thank you. Next slide.
Excellent. I appreciate it. We had a lot of information, and 45 minutes goes by really fast, and we covered a lot of ground. Obviously, our contact information is here. We're here to help and support you in any way we can. Obviously, we have a lot of the depth and resources when you look at a lot of our clients, and I'm very proud of, how many have got PPP loans, and everyone is doing pretty well right now. So we're here to help you. There's a lot going on and a lot of uncertainty. So let's just make sure we have a very good plan to get through this. That's it. I want to thank everybody for joining us this morning.
Thank you. Again, this is Lori from the Chamber, and I just wanted to thank you all from UHY for your great presentation. It was very informative, and I appreciate your time. To the participants, you will receive an email from me with a link to today's presentation. And please be sure to check DetroitChamber.com for more upcoming webinars. I know we have another one actually tomorrow morning with UHY as well, with a different set of panelists. So be sure to check out that information, and we will see you soon. Have a great day. Thank you.
Thank you.